Thank you very much to all the organizers and for inviting me in this great conference ISBIS Kochi 2020. Before I start my presentation, I would like to give you a disclaimer that this is not a financial advising, rather than it's an academic paper that we have found certain features in the market and that we are presenting this academic paper in this conference, and this is not a financial advice, and one should not consider it as a financial advice. This is a joint work with my colleague at Indian Statistical Institute in Bangalore, Professor Ritu Sen. The outline of the talk is, first I will give you the introduction of the problem that we have in hand, and then from the introduction I will motivate you to problem statement. Then we will talk about the statistical methodology that we have developed to solve the problem, and then we prove certain mathematical results, certain optimality of our methodology. Then we provided some simulation study and empirical study. The paper is being published. The title Sparse Portfolio Selection via Multiple Testing is being published in Sankhya B in the current issue. All the codes, the R codes for this project and the paper that we have used are now available in the GitHub. So you can download the R codes and try out for yourself. Suppose P sub T is the adjusted closing price of a stock on Tth day. Log return of a stock is log of Pt minus log of Pt minus 1. Similarly, we can define the price of a closing value of a market index on a Tth day, and log return of the market can be defined in the same way. Risk premium is defined as the RT, the log return, minus RF, the risk-free rate of return. RF is the risk-free rate of return. In India, we typically call it repo rate, the rate at which the big commercial banks buy the sovereign government bond from Reserve Bank of India. R sub T is the premium that an investor earns over the risk-free rate of return. Let us understand what this risk premium is. Suppose you invest your money in State Bank of India's fixed deposit, and State Bank of India gives you an interest income of 6%. Now, instead of investing in SBI's fixed deposit scheme, suppose you invested in equity of Reliance Industries. Suppose the share price of Reliance goes up by 15% over a period of 1 year. So your risk premium is 9% because it is 15 minus 6%, that gives you 9%, and this additional 9% you are earning for taking risk by investing in the equity of Reliance Industries. Alternatively, suppose share price of Reliance goes down by 15% over a period of 1 year. So your risk premium will be minus 21%, because you are not only losing 15% of your equity, you are also losing the 6% interest income that you would have earned if you would have invested in the State Bank of India's fixed deposit. Big question, should we invest in equity or exchange traded fund? What is exchange traded fund? Exchange traded fund or ETFs are special type of mutual fund. It says it follows exactly the market index. So either you can invest in some equity like Reliance Industries or State Bank of India's equity, or you can invest in the Nifty 50 ETF. We have to model risk premium of equity as a function of risk premium of the market ETF. So you have either of the three instruments to invest. You can invest in State Bank of India's fixed deposit, which guaranteed 6% return, or you can invest in the market in the Nifty 50 ETF. By investing in Nifty 50 ETF, you are just investing in the market, or you can invest in particular equities, say Reliance Industries or HDFC Bank or State Bank of India. Capital asset pricing model for an equity can be explained as risk premium for the equity equal to alpha plus beta times risk premium of market plus some noise. So RT is the return on asset or equity, say return for Reliance Industries. RTM is the return of the market index, for example return of Nifty 50 ETF. RTF is the risk-free rate of return of say SBI's fixed deposit scheme. So we call this risk premium. So we are basically modeling capital asset pricing model as risk premium equal to alpha plus beta times market risk premium plus epsilon t. This alpha plus beta times risk premium is called systematic risk, and epsilon t, the noise, is typically called idiosyncratic risk. RT can be viewed as a premium of taking risk with equity. RTM can be viewed as premium with taking risk with the market. Systematic risk is the risk which you can explain due to the market movement. Idiosyncratic risk is risk very specific to stock. We cannot explain why it's moving here and there. We can express it as expected value of RT equal to alpha plus beta times RTM, where expected value of epsilon t is 0, variance of epsilon t is sigma squared for all t, and covariance of epsilon t dash is 0. What this alpha and beta means particularly? Beta is known as measure of systematic risk. Now let us try to understand what is alpha. Suppose beta equal to 1 and alpha equal to 0.01. It means if the market return is 0%, still the equity goes up by 0.01%. That means even if market is flat, equity has gone up. Question is why? Because the equity is intrinsically undervalued, more purchase pressure makes the price to go up, and hence you are seeing a positive return in the particular stock, though market is flat, market return is near 0. Now that means alpha greater than 0 means stock is undervalued. Alpha less than 0 means stock is overvalued, and alpha equal to 0 means stock is fairly valued. Now we are making certain assumptions. These assumptions are known as assumptions of efficient market. First assumption is no insider trading is happening in the market. Second, all publicly available informations are already available to everybody and easily accessible. There is no substantial tax, transaction cost, entry or exit bar, and no limitations on long and short positions. Now we do know these two assumptions, the third assumption and fourth assumptions, these two assumptions are not really correct in the practical scenario. But under these assumptions, any non-zero alpha will be discovered by everybody in the market very quickly, and people will take positions accordingly. As a result, the alpha will goes to 0. So under the efficient market assumption, capital asset pricing model will be expected value of RT equal to beta of RTM, which you can write it in this form. In most of the textbook on economics and econometrics, this is the model that will be explained. But we do know that the assumptions are not necessarily true, and our problem starts exactly there. So the problem statement. We know that there is no substantial tax and transaction costs or entry exit benefit. This is not true. And no limitations on long and short positions, not true. Because typically, most of the time, you have to put, if you are taking a short positions, you have to put a margin money against your short position with the exchange or with the broker with whom you are doing the trading. So as a result, it limits your ability to make short positions. Wherever in the long position, you can take any long positions that you want to make. So this results are asymmetry in the market, and this resulting asymmetry may deviate alpha from 0. So now it becomes a testing of hypothesis problem. Null hypothesis alpha is 0, that means stock is fairly priced, as our textbook says. Alternative hypothesis is alpha is non-zero. There are P equal to 2000 stocks in the market. Typically in any given day, there will be about 1500 to 2000 plus stocks will be registered in the National Stock Exchange, and in the Bombay Stock Exchange the number of stocks registered or listed rather will be around maybe 2500 plus. So efficient market hypothesis tells us that all stocks are fairly priced, that is all H naught I alpha I equal to 0 is the efficient market hypothesis, and the alternative hypothesis is alpha I not equal to 0 for all at least one I, then that is means it is deviating from efficient market hypothesis. I equal to 1 to P. There are 2000 stocks from where we have to choose. Hence, it becomes a multiple testing problem. The problem feature is if a portfolio is constructed based on P tilde many asset, P tilde is less than 2000, maybe 100 assets, all of which have alpha equal to 0 and beta equal to 1, then portfolio return will mimic the market return. We proved a result where we showed that we can select P tilde, which is less than P many assets for the portfolio out of P many assets available, such that the entire idiosyncratic risk will be washed out. Now we are going to define a concept called oracle set. Suppose the market is not efficient. There are Q many assets whose alpha are greater than 0, where Q is less than P tilde and definitely less than capital P. So the P is the number of stocks that we have in the market, P tilde is the number of stocks we have in the portfolio, and Q is the number of stocks whose alpha is greater than 0 that are available in the market. Let us call this set AQ. We can construct a portfolio P tilde with P tilde assets such that probability that AQ, this oracle set, belongs to your portfolio with certain probabilistic bound. Suppose the market consists of 2000 stocks and a portfolio manager wants to build the portfolio with P tilde equal to 100 stocks. If Q equal to 5 many stocks are available with alpha j positive, then portfolio manager would like to build a portfolio such that these AQ equal to 5, these 5 stocks are going to be the subset of the manager's selected portfolio of 100 stocks. A manager would not like to miss out those 5 stocks which are not fairly priced, which are undervalued stocks. In other words, the manager wants to build her portfolio in such a way that she does not want to miss out the set of 5 undervalued stocks. That is, she wants to employ a statistical methodology such that probability of these undervalued stocks, a subset of her portfolio, this probability would be very high. Note that if the market is efficient, then this oracle set will be null set. The problem reduces to identify the oracle set AQ. Essentially, it's a multiple testing problem. Now, what kind of statistical methodology we can apply here? We can easily apply a Bayesian, hierarchical Bayesian approach for k-factor models where RTI is the return of a stock which follows normal xt theta I, sigma I square. I is the ith stock, I runs from 1 to p. Theta I we can give a prior, and then sigma I square follow inverse gamma, lambda follow Wishart, and tau square follow half Kochi distribution. Alternate statistical methodology that we tried is k-factor model with discrete mixture prior. One of the problem with the hierarchical regression model is if the p is 2000, that means we have effectively we are going to fit 2000 hierarchical models for each of the stocks, which is very cumbersome, but we can, though we have implemented in our case. We propose to use a discrete mixture prior, commonly known as spike and slap prior. Theta I follow 1 minus p with measure at mu 0, discrete measure at mu 0, and p times with k plus 1 variate normal mu 0 lambda 0 inverse. As now this p goes to 0, it becomes a sparse model. That means it becomes a very efficient market or nearly efficient market. We propose a Bayes optimal rule using Bayes factor, which can be decomposed into a little bit cumbersome quantity. Si is sort of a exponent of the multivariate Gaussian kind of thing, and this Bayes optimal rule is to reject a null hypothesis if Si is greater than Ci square minus, which is Ci square has this form. We call this rule a Bayes oracle rule. Since p lambda 0 is unknown, we cannot attain this in finite samples. So we proposed an alternate test, which is Si tilde is greater than C square, which Si tilde has this form, which we can empirically evaluate using the data. We show that new test attains asymptotic Bayes optimality under the sparsity. Certain mathematical results we have proved under certain assumptions. As p tends to 0, the type 1 error goes to 0 and type 2 error has a certain bound. So that means for very sparse model, type 1 error goes to 0 and type 2 error is stochastically bounded. Certainly, statistical power is guaranteed for sparse market, that is when the market is nearly efficient. For that kind of market, certain statistical power is guaranteed for this kind of statistical methodology. However, if the market is not nearly efficient, like some emerging market, we have found that this kind of statistical guarantee is not going to work because not many of the stocks are not actually fairly priced. We did an extensive simulation study. Because of the time constraint, we will not be explaining all. We did 4 different simulation study, and some of the observations are as follows. As sparsity tends to 0, probability of type 1 error goes to 0 and probability of type 2 error is bounded, as our mathematical results showed us. Performance of SI tilde attains the performance of SI, the asymptotic base of optimality under sparsity. This result, our proposed test, do attain Bayes oracle test. As the sample size n increases, both probability of type 1, type 2 error and the probability of misclassification drops. It indicates increasing statistical power even when the sparsity parameter p is near 0. As p goes to 1, the model becomes dense, the market is extremely inefficient. Most of the stocks are not fairly priced. One should not use these tests. Type 1 error increases significantly dramatically in this test. As sparsity tends to 0, type 1 error of ABOS test goes to 0. Probability of type 1 error for large lasso method also demonstrate flat behavior like diffuse power prior. However, it is more than that of diffuse power method. Performance of ABOS portfolio is similar or equivalent to the Oracle portfolio. The empirical study we did is we considered 13 years of daily return from January 2006 to 2018 of October. About 500 stocks listed with New York Stock Exchange are being considered. S&P 500 index, Dow Jones Industrial Average, New York Stock Exchange Composite, Russell 2000 index, and VIX or the volatility index are being as well considered. All data were downloaded from Yahoo Finance. S&P 500 index was considered as the benchmark market index. Indices like Dow Jones Index, New York Stock Exchange Composite, Russell 2000 are considered as different additional factors in the 5-factor models. On the 10th month, we run procedure over daily return of the 10th month. This is our backtesting strategy. There are 500 many assets with risk premium R1 to Rp, and the market is P greater than equal to N. The N is typically 22 or 23 days of return, and we select about P tilde equal to 25 many assets which are underpriced, and our revised portfolio is T plus first month would be composed of the underpriced stocks. Then we pretend to invest in these 25 stocks for the T plus first month and record the performance of the portfolio. And we keep doing for month after month over the 13 years of time period. The results are as follows. The black line that you see is actually S&P 500. The red line is what you see, this vanilla capital asset pricing model with maximum likelihood estimates. The green line that you are seeing is the portfolio that was constructed with Lars Lasso method. The dark blue line is the 5-factor model with horseshoe prior or our ABOS method, and the hierarchical Bayes method, and this light blue line is the K-factor models with Bayes oracle proposed method. So one thing you can see that there is a certain degree of inefficiency exists in the market, and this, if there was no inefficiency in the market, then we would have seen that these results, this portfolio would have performed similar to that of the S&P 500. But these portfolios consistently did better than the S&P 500 index indicates that these methods, there is an inefficiency in the market and one can do make some additional profit out of it. But as I said earlier, this is not a financial advice. This is just an academic observations that we made and published with Sankhya B. Thank you very much.